Hello friends, welcome back to our YouTube channel. If you like this video, please like, share and subscribe. I'll share our videos commanded by our experts, so let's begin.
If you like, please like, share and subscribe. So let's begin our today's topic. Let's begin.
By September 2026, OpenAI plans to execute its initial public offering, targeting a final market capitalization approaching $1 trillion. To reach that number, they need to bridge a gap. Massive private funding rounds earlier this year established their current baseline valuation at $852 billion. Until recently, that entire timeline was frozen by a $150 billion lawsuit from Elon Musk, who challenged the legality of the company's internal operations. A jury definitively ruled against Musk, dissolving the legal overhang that blocked the path to the public market. With that regulatory hurdle cleared, major Wall Street underwriters immediately stepped in to begin drafting the public prospectus. Defeating the lawsuit transitioned this listing from a theoretical concept into an actionable reality, kicking off the highly regulated mechanics required to take a company public. Morgan Stanley and Goldman Sachs are now actively writing OpenAI's foundational IPO documents. They are relying on a specific mechanical strategy known as a confidential IPO filing. Alongside that, OpenAI's chief financial officer, Sarah Friar, confirmed the company will reserve a distinct portion of its initial shares explicitly for retail investors. We will examine exactly how a nonprofit entity executes the largest traditional IPO in history and how allocating shares directly to retail disrupts standard institutional distribution. Mapping these specific events provides the structural blueprint for how the company is currently being re-engineered for the public markets. Before any company can submit an S-1 prospectus to go public, it needs a corporate structure legally bound to serve its shareholders. OpenAI was originally built as a nonprofit foundation, engineered specifically to avoid profit maximization. This creates a direct legal contradiction. Public markets demand a fiduciary duty to generate returns. To solve this, OpenAI stripped away the foundation's central control, converting it into a traditional for-profit model. As a caveat, the nonprofit retains an oversight role within the new framework. This architecture establishes clear equity ownership, creating distinct shares for outside investors. Institutions like Goldman Sachs cannot price or sell a financial asset without a defined corporate governance structure and formalized equity. This corporate overhaul was the mandatory legal prerequisite required to access the public equities market. With the corporate structure solved, the next step is submitting the draft S-1 prospectus. The primary market regulator tasked with scrutinizing this document is the U.S. Securities and Exchange Commission. OpenAI is utilizing a mechanism known as a confidential filing. This allows them to submit their S-1 for SEC review entirely out of public view. In a standard public filing, a company's internal data, ongoing risks, and structural vulnerabilities are immediately exposed to the open market. By placing the SEC review process behind a shaded zone, OpenAI creates a massive information asymmetry. Kept safely within this zone are highly sensitive financial metrics and revenue projections. This secrecy protects the $852 billion private valuation from competitor analysis and media scrutiny. Behind closed doors, the SEC will heavily scrutinize the paperwork, demand endless amendments, enforce strict risk disclosures, and require rigorous accounting adjustments. Handling these demands privately stops negative market sentiment from compounding every time the regulator forces a revision to the prospectus. The confidential filing operates as a financial shield. It allows the company to test regulatory waters and finalize its valuation without exposing its raw data. Once the confidential S-1 clears SEC scrutiny, focus shifts to physically distributing shares to buyers. The standard operating procedure for underwriters is to allocate the vast majority of these shares directly to large institutional clients and hedge funds. A public listing also acts as a massive liquidity windfall for existing venture backers, like SoftBank. The single biggest corporate beneficiary of this massive liquidity event will be Microsoft. Microsoft holds roughly a 27% stake in OpenAI, positioning them to extract immense returns upon listing. Despite this heavy institutional weighting, CFO Sarah Fryer plans to reserve a specific portion of the stock explicitly for retail investors. While the massive main pipe feeds institutional and venture buckets, OpenAI constructed a bypass pipe strictly for retail. This bypass uses specialized directed share programs. Retail participants can buy equity at the fixed IPO price, securing their position before facing open market volatility. This allocation is a mechanical disruption. It forces the underwriters to build a direct pipeline to the public, bypassing traditional institutional gatekeepers. All of this points toward a projected public debut in September 2026. To hit that date, the check gates are sequential. The nonprofit restructure is finished, the legal overhang is clearing, and the confidential SEC review must be completed. Roughly 15 days before the IPO prices, the confidential status drops. The S-1 is legally forced into the public domain. This is when the broader market finally sees the protected financial metrics and the definitive structure of the capitalization table. It is the moment of truth, where the $852 billion private valuation is stress-tested against the public market. This visualizes the target, a capitalization table scaling to the $1 trillion mark, locking in Microsoft's 27% slice alongside the retail tranche. Engineered as the largest traditional IPO in history, reaching this required defeating legal challenges, restructuring governance, and utilizing SEC confidentiality rules. By mandating a retail allocation, the company ensures the public has a mechanically defined pipeline to participate right next to major venture capitalists on opening day. The 2026 OpenAI IPO is a specific application of large-scale financial engineering, converting a non-profit AI lab into a $1 trillion public asset. After years of operating strictly as a private pioneer in artificial intelligence, OpenAI is now preparing for a blockbuster U.S. initial public offering. Following private funding rounds that priced the firm at $852 billion earlier this year, expectations for the public debut have pushed the target valuation toward the $1 trillion mark. To get there, the company is executing an aggressive transition, aiming to list on public markets as early as September 2026. This accelerated timeline is a deliberate move to capitalize on the massive investor appetite for pure-play artificial intelligence assets. Securing a $1 trillion public debut depends on resolving a deep structural contradiction embedded in the company's DNA. Standard public corporations operate under a strict legal mandate, a fiduciary duty to maximize financial value for their shareholders. OpenAI was not built that way. It was founded as a mission-driven, nonprofit organization focused on safe AI development rather than returning capital to investors. This creates a legal paradox. Bringing a capped profit hybrid entity directly to the public equity markets is impossible without first dismantling its foundational legal framework. OpenAI is currently executing a dual-access roadmap, hitting strict regulatory deadlines for its listing while simultaneously re-engineering its entire corporate architecture. Until that governance is completely rewritten, the planned 2026 listing remains a mechanical impossibility. Before OpenAI could even begin drafting its initial public offering documents, it faced a massive legal blockade preventing any structural change. That challenge came directly from Elon Musk, who launched a $150 billion lawsuit against the company. Musk's legal team argued that OpenAI had no right to transition its core intellectual property into a fully for-profit structure. Recently, a jury dismantled that argument, ruling decisively against Musk. This victory immediately validated OpenAI's legal right to execute its corporate overhaul and proceed as a for-profit entity. If that legal challenge had proceeded, the entire 2026 timeline would have been frozen in court indefinitely by the regulatory overhang. Defeating this massive legal challenge entirely cleared the blockade and immediately served as the necessary catalyst for the internal restructuring to finally begin. With the legal path clear, the company shifted its focus to the internal mechanics of the corporate restructuring. This organizational chart shows OpenAI's starting point, a nonprofit foundation positioned directly above a capped profit operating company. That capped profit model is unworkable for traditional public equity markets. A strict ceiling on financial returns blocks the massive inflows of outside capital required for a $1 trillion valuation. To fix this, OpenAI is actively dissolving that capped entity and replacing it with a standard traditional public corporation, but they still have to navigate their founding principles and avoid violating their original mandates regarding AI safety. They are doing this by hardwiring an oversight mechanism into the new entity, allowing the original nonprofit foundation to retain legal authority over the new public corporation. This arrangement attempts to give Wall Street the standard fiduciary duties it demands, while keeping the foundation's original mission intact. Operating a massive public entity that must answer to both institutional shareholders and a nonprofit board requires intense legal engineering. Constructing this highly hybridized corporate entity is the only viable way to bridge OpenAI's nonprofit origins with the reality of a 2026 IPO. When that structure is finalized, we can look at the capitalization table to see exactly who benefits. The single largest institutional backer is Microsoft. Microsoft holds a roughly 27% stake, positioning them for an immense liquidity event if the valuation reaches $1 trillion. They are joined by other major venture capital groups, starting with SoftBank, whose early investments are now poised to generate massive returns. Thrive Capital is also positioned alongside SoftBank, holding a significant allocation of equity. CFO Sarah Fryer has confirmed the company will specifically carve out an allocation of shares for retail investors. This move is designed to capture the consumer enthusiasm around artificial intelligence and channel it directly into the stock's debut. Together, this distribution turns an abstract private valuation into a tangible windfall for legacy tech giants, venture capital firms, and the retail public. With the equity structure mapped out, the company can now execute the mechanical steps to hit that September 2026 target. The immediate next step is an imminent confidential IPO filing, expected within the coming weeks. Filing a confidential S-1 allows OpenAI to negotiate quietly with the Securities and Exchange Commission, resolving the complex regulatory questions surrounding their hybrid corporate structure away from public scrutiny. Right now, the active drafting of this prospectus is already underway. To manage a listing of this scale, OpenAI has enlisted top-tier financial institutions to lead the underwriting. Morgan Stanley and Goldman Sachs are working closely with the company to translate its new corporate overhaul into a format institutional investors can digest. This accelerated underwriting process highlights the pressure to execute the listing while the market's enthusiasm for AI is at its absolute peak. OpenAI's aggressive push toward the public equity market represents a massive, highly calculated corporate metamorphosis for the artificial intelligence giant. Defeating the legal blockade from Elon Musk was the absolute prerequisite, providing the legal clearance to dismantle the capped profit model. Only by engineering that new fiduciary architecture could Morgan Stanley and Goldman Sachs move forward with the confidential filing expected in the coming weeks. The ultimate test of this $1 trillion valuation will be whether Wall Street is willing to buy into a public corporation that still yields structural authority to a mission-driven nonprofit foundation. If OpenAI successfully navigates this transition and lists by September 2026, the implications will ripple through the entire tech sector. It will establish the legal and financial template for how mission-driven AI research labs can mature into massive public corporations. OpenAI's march toward a trillion-dollar public debut is an exercise in complex corporate reengineering, testing the absolute limits of how tech capitalization works in the modern market.